Welcome to the Explainer. You see a stock price jump up or down, and you think you know what's going on with the company. But what's really happening behind that one little number? Well, today, we're going to pull back the curtain and show you how to give any company a full health checkup.
Right. Because that stock price, it doesn't tell you the whole story. Not even close. To really understand what you're investing in, you've got to look under the hood. So let's think of this as a company health checkup.
And just like any good checkup, there are two key parts. You've got the lab report, that's the hard data, the financial numbers that tell you what's going on inside. And then there's the character test. This is all about the people running the show. Are they trustworthy? Are they actually working for you?
Okay, so here's our game plan for today. First, we'll talk about why we even need a checkup. Then, we'll get into reading those financial vitals. After that, we'll figure out who's running the show. And finally, we'll put it all together for the investor's final diagnosis.
Trying to judge a company based on one number is, well, it's like trying to figure out a whole cricket match just by knowing one team's score. Sure, it's a piece of information, but it doesn't give you the whole game.
So, let's say I tell you a team's current run rate is 8. You're probably thinking, okay, that's pretty decent.
But what if I then tell you that the required run rate to win the match is 12?
See? Everything changes. Now you have context. You understand the pressure they're under, the strategy they need. You get the whole picture. And believe it or not, financial ratios work in the exact same way.
I love this quote because it just nails it. Ratios are our diagnostic tool. They're like that blood report a doctor uses to see past the surface and figure out what's really going on with a company's health. All right, now that we've got our diagnostic tools, it's time to start reading those numbers. And don't worry, this isn't going to be some crazy math class. This is all about smart analysis, and to do it right, you just need to follow 2 golden rules.
Golden rule number 1. You have to analyze over time. A single number from 1 year is just a snapshot. You need to look at the trend over, say, 5 years to see if things are getting better or worse. And rule number 2. You must compare a company against its peers. A ratio by itself is pretty much useless until you see how it stacks up against the competition.
This is just common sense, right? You'd compare Hero Motocorp to other two-wheeler companies like TVS and Bajaj. But comparing it to a supermarket like D-Bart, that's apples and oranges. It tells you absolutely nothing. You've got to compare apples to apples.
So let's see this in action with a really important ratio, gross margin. In simple terms, this tells you how much profit a company makes on each sale before it pays for things like marketing or salaries. It's a fantastic first look at how profitable a business really is at its core.
And this right here is why context is everything. Look at that massive difference. A service company like HCL Tech has huge margins because their main cost is their employees' salaries. But a manufacturing company like Adani Wilmar, which deals with physical products, operates on razor-thin margins. Now, neither of these is good or bad. They're just different businesses, and that's exactly why comparing against peers in the same industry is non-negotiable.
Okay, so we've got the lab report back, and the numbers are starting to make sense, but that's only half the checkup. Remember, now it's time for that character test. We need to ask the big question: can we actually trust the people in charge? This all boils down to something called corporate governance.
So here's how it works. You've got the shareholders, the owners, and yep, if you own even a single share, that's you. Then you have management, the folks who run the business day to day. But who's looking out for the owners? Who makes sure management is doing a good job? That's the board of directors. Their whole job is to be the watchdog, protecting your interests. And here's why this matters so much. Good, strong governance, the kind built on trust and transparency, is what creates long-term wealth. Think about companies known for this, like Infosys or TCS. On the flip side, weak governance, where the watchdogs are asleep or in cahoots with management, that leads to secrecy, mistrust, and it can absolutely destroy shareholder wealth. One of the most important players in all of this is the independent director. These are people on the board who don't have any major ties to the company. They're not the CEO's best friend or a major supplier. You can think of them as your representative, your unbiased voice inside that boardroom, whose job it is to ask the tough questions for all the shareholders.
All right, we've done the lab work and we've done the character test. Now it's time to put it all together for our final diagnosis. Because here's the thing, a truly healthy long-term investment has to have both. It needs strong financial vitals and a trustworthy character. One without the other is a massive red flag.
So this little chart here is basically your cheat sheet. The sweet spot, the place you want to be, is the top left.
Good numbers and good governance. That's a big green light. But what about a company with amazing numbers, but really sketchy governance? That's a trap. You avoid that. And a company with great people, but terrible numbers? Well, maybe you keep an eye on it, but it's not a buy. And bad on both counts? Don't even think about it.
So the next time you're looking at a company, I want you to ask yourself this very question. Are you just going to glance at the stock price, or are you going to order a full health checkup? Because making that choice to combine the lab report with the character test, that's what really separates a short-term gambler from a true long-term investor.